We can own stocks and bonds issued by other companies for lots of reasons. Maybe we have a few extra dollars laying around and we're tired of earning 0.5% in our local bank account. Maybe we think we can make money by actively trading stocks and bonds. Maybe we want to buy the stock of another company because we want to exercise some influence over them. Whatever the reason, we're going to account for them in different ways depending on our intentions and depending, in the case of stock, how much we own of the other company. And we're going to treat them on our income statement and our balance sheet according to the different rules. The tricky part is, what do we do about unrealized gains or losses? In other words, while we hold this stock or while we hold this debt, what happens when it goes up or down in value? So before we get to those specifics, remember we have our income statement and we have our revenue minus our expenses to give us net income. And then below that, we also have this category called other comprehensive income. Remember, our statement of retained earnings is retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. And our balance sheet on the left-hand side is our assets, and that's where we're going to put this debt and this equity when we buy it. It's an asset. We own it. We're going to hold it. And on the right-hand side, there's two subcategories to our stockholders' equity section. There's the retained earnings, and there's the accumulated other comprehensive income. So net income is going to close out to retained earnings, and other comprehensive income is going to close out to this accumulated other comprehensive income. Let's start out talking about debt. So we own bonds of another company and we plan to hold it until it matures. So when we buy it, we put it on our balance sheet at our cost. If we buy it at a premium or at a discount, we're going to amortize that premium or discount, increasing or decreasing our interest revenue every time we receive a cash interest payment. And if it goes up or down in value, we don't care, because we're just going to hold it till it matures. And so we're just going to slowly amortize that premium or discount until it's on our books for exactly its face amount. Next, let's talk about available for sale debt. We bought the bonds. We're not actively managing any kind of bond portfolio, but if we need the cash, we'll sell the bonds. If the interest rates go down and the bond price goes up, we might sell it. We're going to put it on our books at what it costs us, and then we're going to write it up or down at the end of every period. So we're going to have an adjustment account over here, and when it goes up, we're going to debit it. When it goes down, we're going to credit it. And the corresponding debit or credit is going to be to this other comprehensive income account, which is going to close out to accumulated other comprehensive income. And that's how we're going to keep track of the value of available for sale securities. Trading securities means that we intend to actively manage this portfolio of stocks and bonds. We're going to buy and sell, in this case, debt, to try to make money. So just like the available for sale securities, we're going to mark these things up or down after we buy them with a market adjustment account over here. But instead of debiting or crediting other comprehensive income, we're going to recognize income or loss up here that will be incorporated into our calculation of net income. In other words, we said we were going to try to make money, and now we have to book that gain or loss into our net income, which of course is going to close into our retained earnings. When we're talking about equity, buying the stocks of other companies, it gets a little more complicated. How we account for unrealized gains or losses is going to depend on how much we own of that other company. If we own less than 20%, we're going to treat those equity securities just like we treated our debt securities. So if they are available for sale, in other words, we bought them because we wanted a few extra dollars in dividend revenue, we'll sell them when we need the cash. They'll go on our books at our cost. Every period we'll mark them up or down with a market adjustment account, and the corresponding entry will be to other comprehensive income. If, on the other hand, we bought them to actively trade these stocks, we're going to mark them to market with a market adjustment every period. But the corresponding entry is going to be to an account that's going to figure in our calculation of net income. If we own between 20 and 50% of the stock of another company, it's presumed that we exercise a certain amount of control. And so their income, their loss is our income, our loss. So we'll put it on our books at what we paid for it. But for example, if that company then makes $100,000 in net income during the year and we own 20% of them, 20% of that net income is our income. So 20% of $100,000 will be $20,000. We will increase this asset by $20,000 and we'll book some income on our books for that $20,000. And then the payment of a dividend is seen as a cashing out of the investment. So we'll increase our cash with a debit and we'll decrease our stock of that company on our books, our investment in that company on our books, by the amount of that dividend. That's called the equity method. And finally, if we own more than 50% of the shares of stock of another company, we're going to consolidate them. We're going to prepare what's called a consolidated set of financial statements. So we're going to include them 100% in our financials and then subtract out the non-controlling interest from our income statement and from our balance sheet. The non-controlling interest is the part that we don't control. Okay, I hope this overview makes this chapter easier to read. Accounting books have a tendency to throw new accounts at you and not explain whether they're income statement accounts or balance sheet accounts. Hopefully this will help clarify that for you and make the reading slightly less confusing.